It's time for Charting Futures, where we dive into the futures markets through the charts. Today, we're taking a look at the S&P 500 with stocks down once again. Now, after finishing lower last week by more than 1% and having its first four-day slide of the year, the S&P 500 is down again today. It's not clear what the trigger is for all this bearish action, but it does follow in the path of volatility that we've seen this year, something that can put investors on edge, and particularly with modestly extended valuations. But what about the technicals? Are they extended as well? Let's hop into the Bloomberg and take a look at a chart of the S&P 500. And this is #BTV 4399. It's a longer-term chart of the S&P 500 going all the way back to the election and the quote-unquote Trump trade. We see a beautiful uptrend. In pink is the 50-day moving average. That represents the near-term momentum of the buyers. And we see that the S&P 500 has really moved right along with that, telling us that the buyers have been in control until this year. This year, we had a really big rally in January. The S&P 500 had its best month since March of 2016. But then in February, some real bearish volatility that took the S&P 500 below that 50-day moving average toward the 200-day moving average. This whole area is an imperfect diamond top, but it's interesting to note right now it is starting to confirm perhaps with the S&P 500 dropping back below that trend line, below the 50-day moving average. If it drops back below the S&P 500, the low on February, it suggests we could see a move all the way below 2,300. That would be pretty bearish, clearly, and you'd have to wait for confirmation of it. To talk about more about how we would potentially trade this, let's bring in David Weiner, a partner at Silver Pine Capital. And David, what's your near-term view here for the S&P 500? Could you see the S&P 500 doing what that chart suggests?
Sure. So one of the things we always think about at Silver Pine, Silver Value investors, is we come back to valuation and earnings. And so we think that fair value near term for the S&P 500 could be roughly 24.25, which is, roughly 12% below where we are today. That's the bad news. So we think that that's certainly possible, but we obviously don't know what's going to happen.
So fundamentally, knowing that you don't know for sure, we had one guest on last week that was talking about a possible tax cut bubble. Do you think that this rally, this big Trump trade, has been on thoughts around the tax cuts and what that means? And do you think that there is a cooling off period ahead due to that?
Well, first of all, we would say that earnings are now, the consensus for the S&P 500 for 2018 is about $158 a share. So we could say between 155 and 160, about 158. So I would say that some of this, the estimates about the tax cut is actually baked into the earnings. And so you could argue that that's brought valuation down slightly, although I would say valuation is still pretty elevated.
And before we turn to your trade, just one more question, since you're talking about valuation. Everybody's been talking about the influence of rising rates and how that could be a pressure on valuation, whether you look at it from the discount rate and future earnings streams look less attractive, but basically a repricing of risk. Do you think that that could be a factor?
I think that's always a factor. I think there's seems to be probably more volatility ahead rather than less. But again, we just come back to the idea that valuations definitely feel frothy, and they could get frothier before they get less frothy.
So that brings us to your trade, because you have an interesting trade here, at least to me. So can you talk to us a little bit about it? And we have the contract table on the front month E-mini futures here for the S&P 500. But can you talk to us about your options trade?
Sure. I mean, when we look at this, and you're talking about like in June, we'd rather do like a deep in the money call spread. So therefore, we'd prefer not to have to rely on markets going up to make money. And that's kind of, at the core of when we think about markets. Is there a way we can do this without having to rely on markets going up to make money, where there's a few ways to win? And
so is that why you would do a deep in the money call spread as opposed to buying puts on your bearish view?
Sure. Well, I wouldn't necessarily say it's bearish. We would even take this view for bullish. But in terms of buying puts, you still need the market or whatever asset it is to go down for you to make money. We'd prefer not to have to rely on that to happen to make money.